Lots to talk about this morning, Daniel.
Yeah.
Unemployment rate kind of fell off a cliff.
Yeah. I mean, I guess you take it as a win, I suppose. Like there's some stuff in between the lines that I think is worth paying attention to. So mostly part-time jobs.
Yeah.
Which, I mean, you'd want to see full-time jobs. So that would probably be the bad news there. The participation rate fell. So fewer people are looking for jobs, which is not always optimistic. That could be because temporary foreign workers are leaving Canada. It could be because people are giving up. The youth employment rate rose for the second month in a row, which is like, that's the thing I've been paying the most attention to, because I think generally like month to month unemployment doesn't matter a ton. Like, eventually it's gonna peak and then it's gonna fall and we'll get through it. Like but long-term structural issue of youth unemployment is very concerning.
Absolutely.
But it seems like we're on the right side of that now, hopefully. Fingers crossed. Bond market, didn't like it, or did. I don't know. I guess it depends on what side you're on, but it looks like, they're like the market's basically forecasting that we might actually have to hike next year. Not that I see that happening, but bond market's saying that the economy's running too hot.
And I think when you look at it, I mean, like you said, it's mostly part-time jobs. We've lost a lot of full-time jobs in the last, 2 months, right?
Yeah. Generally lost a lot of full-time. And then in the last employment print was a lot of, it was all public sector and no private sector, which, I mean, that to me is just like, it's pure government spending. Like the government can basically do whatever they can to make the economy look good. We saw that with last Q3 GDP print as well. We avoided a technical recession with a huge huge quarter of GDP growth, and it almost all came from government spending. So the concern that I have heading into 2026 with that is that we're heading into an era of what you would call fiscal dominance, which is basically where the central bank is irrelevant, and because the government is spending so much money that they can't cut or increase rates to game the inflation curve. Like the Bank of Canada has very little control if the government is spending so much money, and that's creating inflation, creating jobs, creating wage growth. Their role is basically nominal.
And I think that leads into next week, right? December 10th, which is our last Bank of Canada announcement. There's the banks that have been I think it's kind of split right now. Yeah. Well, maybe today after that news, it'll be different, right? But there's that split of where we'll see a 0.25% drop. We might see it just be flat. And then Scotia's predicting potentially an increase if it's not now, like you said, in 2026. Yeah. With these job numbers today, what do you think for next week?
I think they'll just hold, to be honest. Yeah. They tend to like to hold, and they like to be late to the party, which I think is kind of the central bank's job. Like they do have to be a bit reactionary. I think the bond market is supposed to be forward-looking, and the central banks are supposed to be reactionary because they have a much quicker delivery to the rate environment. Like it's immediate on business credit and variable rates, whereas bonds tend to, like if you're borrowing on fixed credit, it's not an immediate, most people are on 3-5 year terms. Just think about your mortgages, right? Like if the bond yield goes up and down, I don't really care if I'm on a fixed. I'll care in a year or two when I'm up for renewal, but I don't care during my mortgage term what's happening to a fixed rate. So that's why I think that they tend to be reactionary, and I think that they're more likely to pause. I don't like the challenge is that your economy is sort of like bifurcated into a couple of different pieces, right? Like you have all of these positive figures and we're creating jobs and the GDP is growing, but Canadians still feel like they're in a lot of trouble, right?
Absolutely.
Like financially, nobody looks at their household finances right now and says, I'm way better off than I was last year in 2023 or in 2022. And so that's the problem that I think the central bank and the government is really dealing with, is how do we not continue crushing the consumer? And the big reason for this is Canadian household indebtedness is at record highs. Well, just coming off record highs, but it's trending back up. Yeah. So if we're continuing to pile on debt, that's not a positive signal for the economy, and it just keeps kicking the can down the road because at some point we have to pay that back.
And I think I talked to some economists that say realistically the Bank of Canada has to decrease bank prime by another like full 1% to start seeing the economy start to revive again. Yeah. But, there's that saying that Tiff Macklem said, I think at the beginning of this year, is that, monetary policy and fiscal policy, they need to row in the same direction. And we're not doing that when the government's spending so much money. And to some extent, there is a rationale why the government's spending money. Obviously, we're dealing with tariffs. we've got to look at ways that we can, trade interprovincially and not just, we were so dependent on the U.S., but that takes time and it's going to take a lot of money. And, obviously debt is what's causing us with inflation. So I guess my question to you, and I think to a lot of people that follow you too, is what's 2026 going to look like for a buyer right now or a seller in this market in Canada?
Yeah, I think that the big theme is like, are you confident that your job's going to exist in a year or not? And like that, and the labor force survey from Statistics Canada today also highlighted that, where like, buyers, people are basically feeling like the least confidence in job security that they've had in a long time. And a lot of that's because of obviously tariffs, the trade war, Kuzma renegotiation, auto sector, manufacturing jobs leaving. Algoma just did a layoff. We saw those jobs leave from the Brampton Stellantis plant. Oshawa has the highest job unemployment rate in the country due to the auto sector. Windsor's not far behind them. Construction, a lot of the construction's rolling over, at least in the province of Ontario, and so you're starting to see job losses there. If people are concerned that they're not going to have a job, then they're not going to buy a house. And part-time jobs don't solve that because nobody's buying a house with a part-time job.
Exactly.
Yeah.
And when you look at just like today's numbers, it is more part-time jobs, like you said, that are created. I think that when they break that down and when the Bank of Canada looks at that, to your point, they'll pause. They're not going to increase bank prime. But realistically, a decrease of 0.25% isn't going to help move the market. It's not. It's, again, it's, and I look at housing too, like, and I've seen this time and time again, and you've said it. It's not a supply issue anymore. It's an affordability issue, but it's an affordability issue where I think it's like, we have to see that drastic decrease again to start stimulating the market because we've had such a correction in values here specifically. I'd say more in Ontario than in BC when you look at it, because we don't have the leverage to see values go down $100,000 or $200,000. Like people don't have that in their budget, especially when I see it on the mortgage side. They don't. Where in BC, when I talk to mortgage agents or realtors out there, $100,000 to $200,000, which seems to be across the board, there isn't a big deal when they're equity rich, which has been for a very long time. Right. It's Ontario that's going to feel the brunt of it.
Yeah, I mean, we do have Ontario does carry the most mortgage debt and have the highest consumer credit, other than Saskatchewan, but they're kind of irrelevant in that conversation because they seem to be doing fine on the house valuation side of things. But like wherever you see the most debt is where you're going to feel the pain the most on changes in interest rate environment. I would agree with you. Even if the Bank of Canada did decrease by 25 basis points, it would be purely theatrical anyway. They would literally just be saying, "Hey, we're still trying, guys." But and so it really is just a signal at this point. Like the other piece is, if you get to another 25 basis points, I think you hit the top end of the stress test. And so on mortgages, anything they decrease below that, it doesn't actually have an impact on borrower buying power. So for the housing market, it's kind of irrelevant. They're kind of irrelevant after that. And so if anything, the reason why they would continue cutting is actually to ease pressure on owners, sellers, so that when they renew, because we have the big renewal wall coming up, they're actually trying to game the supply curve and ease supply less than create demand. Because the stress test has eliminated their ability to create demand. The question mark heading into 2026 is, does the stress test go away? Because I know OSFI is doing a lot of studies on that right now with the 4.5x loan to income portfolio. Basically, they're running a test that they look at a bank's entire loan portfolio, and it has to be an average of 450% loan to income. Based on Bank of Canada's most recent research, the loan to income of new mortgages is trending down significantly. So I would guess that would yield positive results next year. And if it does, then we could see the stress test go away. I think that from a policy perspective, maybe they don't remove it entirely, but it could, they maybe reduce it by 100 basis points rather than, so it's 200 right now rather than 100, and maybe they get rid of the minimum qualifying rate of 5.25. That to me is the thing that I'd be paying most attention to heading into 2026, because I think there's not really much that could stimulate demand beyond that.
No, I agree. And I agree with you in terms of, I think that we'll probably see the stress test go down about 100 basis points. Yeah. I think we're going to see some challenges is that renewal wall that you talked about. We've got the most mortgage renewals coming up next year for the, especially that 12 months for sure. Yeah. And I think that what you're going to see, especially here in Ontario, is where values let's talk about most people in Canada during this last 5 years probably took a 3-year fixed rate term. Just were hoping that rates would correct itself and come down. So those mortgages are coming up for renewal. And if they bought 3 years ago, which was a peak of the market, those values, because of this increase and decrease in the values, they've actually are probably in a negative equity position if they did put 5% down an insured mortgage. So the fact of these couples or individuals that own these properties, they won't have the opportunity to get competitive interest rates. They may just have to renew with their existing lender, or if they have outstanding debt, which a lot of people do when they come up for renewal, is consolidate debt. They're not able to do that. Yeah. And I'm wondering if we're going to see people going into, you'll see power of sales increase next year, or you'll start to see people higher delinquency because people won't be able to afford that increase in interest rates. You know, it's gonna cause a very interesting year. Specifically, I think in Ontario, we're going to see that.
Yeah, I would agree. I think about 60% of mortgages will renew at higher rates, 40% at lower rates, and that would be like your 3-year borrowers. Your 5-year borrowers would be the ones who bought in 2021 at peak rates. Probably a lot of them went at variable, right? Like I think that was the highest portion of variable rates we've ever seen. That was actually where the stress test failed the market, right?
Exactly.
Because the bond market was already ripping, forecasting higher rates, and people couldn't afford to buy on fixed rates at that higher stress test, so they bought with a variable, and it created way more risk, which is where, like, that's the one piece of the stress test that I think is funny and in hindsight probably made it create as much risk as it got rid of. But I think you're right. Like, I think as it stands, the renewal wall is going to be a big issue. CMHC's most recent data on the number of uninsured and insured renewals that banks are doing is up 100%. So, and the reason is because people are trapped in their loans. They have no choice. And so if I'm with RBC and I got a loan in 2020 or 2021, I can't go to BMO and say, hey, will you renew this? Because they're underwriting me. I'm not stress tested, but I still wouldn't pass on underwriting today at a rate that's 2 times what I qualified for back then. And so people are stuck and they just have to hit the renewal box. And I know you've talked a lot about the idea of right sizing, which to me, like, I hate to be a dick about this stuff, but like, if you can't afford, if you couldn't afford to shop your deal and get a better loan, that tells me that functionally you would not actually be able to qualify for that house if you didn't have the option to check the renewal box. Okay. I think banks are pretty reasonable in their underwriting and pretty responsible in their underwriting. And if you couldn't go and buy that equivalent house in today's market, that means that you might not be able to afford the house. And maybe it's worth thinking about, is there a better option for me given values are way lower?
Exactly. Yeah.
Does it if I have equity in my property, does it make sense for me to sell and buy something else? And that's the idea of right sizing that you've talked about, right sizing your mortgage, et cetera, because there's a lot of people, and this is why it's such a drain on the economy. There's a lot of people who are house poor in today's economy, and that's not good for them. It's not good for your stress, it's not good for your family's finances. It's no way to live your life. And so that's like one of my bigger concerns on sort of a personal level heading into 2026 is people, I think we have to get away from the fact that like this obsession with homeownership and like homeownership by any means necessary. And we always need the bigger house and the status symbol and whatever. It's like, you know, what's actually a great status symbol is that like you can afford to retire at a normal age because you didn't make dumb financial decisions when you were younger. I think we have an opportunity for people to reconfigure some finances in the next couple of years and make good decisions. And you were really the one who tipped me off to that with the whole idea of like, we're seeing a lot of people just saying, hey, it does make more sense to sell, maybe rent for a couple of years. Like renting is objectively on a spread basis on a monthly, as long as you're good at saving money and investing money, you can outperform homeownership at least while prices are falling. Or buy a better house, buy an investment property and rent a house, buy a house that you can house hack and maybe get some income from the basement. Exactly. Like there's so many options for people, but people just don't think about it and they just check the box and commit themselves to another 5 years of indentured servitude.
Well, I think because Canadians, optically and have been so conservative, but really hawkish in terms of making decisions because it's a scarcity mindset. And to be honest, financing is such a personal I want to talk about what's the biggest topic that's out in the news, I think, right now is RECO and what's happened.
Yeah, I mean, the provincial government took over the Real Estate Council of Ontario because they were
Did you see that coming?
Bad.
Did you ever think that that would ever be possible?
Yeah, as soon as the iPro stuff dropped, I was like, it's over for RECO. I think I was the first person to say it, to be honest with you.
Wow.
Yeah. It happened to FSRA, right? Like that was what happened to FSRA, 15 years ago, 10 years ago? Yeah. The mortgage industry was at one point self-regulated, if I'm not mistaken.
Yeah, yeah.
OMVIC, same thing. I mean, like it's funny because I hate bureaucracy, okay, and I hate large government, like more than anyone in the world, anyone that I know, I would say. But I would say that this is one instance where, like Milton Friedman talks about the three functions of a government, and one of the primary functions of a government, one of those three functions, beyond military and public safety, is enforcement of contracts. You need a rule of law just between individuals, right? So if you and I make a deal and we write it on paper, then I need to be able to enforce that. And our industry, the real estate industry, is an industry that is designed to help people. It facilitates contracts. If there's no trust in that industry, it's a very big issue. And I think the Ford government actually, it looks like to me they have a bit of a hit list. So they went after the landlord and tenant board, right? And they did the same thing. They improved the strength of contracts in the landlord and tenant board by making it easier for landlords to get a fair judgment. They did the same thing with the Ontario Real Estate Council of Ontario by taking over and ensuring that real estate contracts, trust accounts, can be trusted, and consumers can have confidence that the system is going to work for them. So it's one of the few areas where I actually think that government involvement is appropriate.
So what do you think, if you've got a real estate agent that's listening to this right now, which I'm sure there will be thousands that will, what would you say to them right now in terms of what your forecast is? Do you think there'll be more regulation in that space? Do you think it's going to be a better thing that the government's involved in it?
I don't think that there will be more active regulation, such as like audits, et cetera. I think that reporting and compliance will go up, which is an example that you would see with FSRA, right? You saw that in your space, or any, like, look at any space. I think that one of the things that we'll probably see happen, that you saw happen with FSRA and OSC, is representation is going to probably be under siege, which is where agents have been misrepresenting returns on real estate investments for a long time. And now that we're into if this gets pulled into FSRA or OSC, then the agents who are saying guaranteed X% return or whatever, this cap rate or that on deals, that's could go away. That's probably one of the biggest things that I think, if they end up adopting a similar framework to FSRA or OSC, like when they took those over. But otherwise, I think that the amount of audits might actually go down, or the severity of audits, like when they actually come in. But what they'll have is more frequent, like, annual reporting from these institutions, similar ways that, like, they want to standardize things, right? So that it makes it easy for them. And then they'll probably use some sort of like technology or people to review an annual standardized report from each institution. They'll probably have purview on trust account oversight, so they always can have the eyes on, because that's where the biggest issue is going to happen. Yeah, there's some funny business between, like, contracts, initials missed, whatever, but I think, like, that stuff's by and large not a huge deal, because most of these deals end up ultimately getting executed by lawyers, right? They create a new agreement of purchase and sale, and everybody agrees to a new set of terms on closing. So I think contract compliance will be a little bit not more lenient, but it won't be as much of a focus of these audits. I think it's more going to be trust account compliance, execution compliance, and I think a lot of the Ontario Real Estate Association, Canadian Real Estate Association, the boards are starting to see a bit of a threat, because their relevance might actually start to diminish as a result of this, and put all of that on the backdrop of the fact that we have a class action lawsuit hanging over the real estate industry at a national level, which, like, RE/MAX just settled for $8 million again, similar to the it's a copycat lawsuit of the thing that happened in the U.S. There's going to be a lot of changes in the structure of the real estate sector in the next 3 to 5 years.
Do you think there'll be more oversight in the trust accounts? Because I think that's one of the biggest problems, right? That happened with iPro, right?
Yeah, they'll likely come out with some sort of like standardized governance of
which is
and things
which they should do.
Yeah, absolutely. Like
and I'm sure you had a lot of real estate agents from iPro come to you to look for advice, right? Like, so where it's, and I'm sure a lot of people want to know, right? Like even homeowners or existing people that are looking to sell and buy, like what are the risks of what happened there? If you were a buyer and you were in a contract with an agent from iPro when this has happened, your deposit, it was sitting in that trust account.
So up to a certain amount, it's insured by consumer protection, which most of the deposits were covered. A lot of realtors will potentially lose commission as a result of that. So like consumers come first and then the realtors commissions, but we don't really know, right? Like we don't know yet what the actual end game looks like, but what, as it stands right now, if you were a buyer who bought one of their deals and the money from the trust account was spent, then there's a risk that, well, at a minimum, it's tied up. Like it's all those accounts are frozen, which means that on closing, there's a absence of funds towards the deal, and something needs to be done to solve for that. And that's creating obviously a lot of problems. A lot of realtors, basically their HST that was collected by the brokerage has been completely wiped out. So they're in functionally like a loss position on their tax reporting, which is crazy. So like if you made $100,000 and your brokerage collected $13,000 in HST to remit to the CRA and they never sent it, then you just didn't. This is something that's actually common with a lot of the agents who we've spoken with.
Wow.
Yeah. So you would have to write that off as a loss, but you still would owe all the HST that was collected, which is a huge mess. And for buyers, I think trust monies, deposits being trapped and jeopardizing deals. For agents, obviously commissions being trapped and not being able to get paid on transactions that they've done and not knowing whether or not they're actually ever going to, because we don't know how much money is actually there.
It's incredible, right? Like that's actually transpired. But having said that, we've had it on the mortgage industry as well.
Doesn't surprise me, to be honest. Like, I mean, like people, consumers hate the real estate industry, right? Like they think that we're worse than used car salesmen, and in many instances, they're not wrong. And so consumers have been saying this stuff for ages. The real estate industry is doing bad stuff. They're ripping people off, blah, blah, blah. And everybody's just like, oh, okay, whatever. And I think that regulators and the government and a lot of folks ignored how much that sentiment was growing. And I found that would be one of the most efficient ways to deliver sort of like the message that I want to get through to the industry, which is that we don't have to be ashamed of what we do. You don't have to be embarrassed to be a realtor. We can just be different than the realtors that other people are talking about when they say that everyone hates realtors. And we can hold ourselves to a higher standard, and we can try and advise clients the best that we can and become as informed as we possibly can. And I wanted to be a part of a company that was using technology to make it possible to do that. At the same time, I think that there's a lot of other ways that technology can improve outcomes for consumers, which, like for me as an example, I'm not an exceptionally good administrator, and technology can do administrative tasks a lot better than me. It can organize my paperwork. It can book my showings. It can liaise with my clients and make sure that they're informed of when all those showings are and what cadence. And my goal is really to help the real estate industry level up. And it's always been that. That's always been what it is, because I grew up in a real estate profession, and I've watched the perspective of the industry deteriorate over the last 20 years. And I don't think it should be that way. And I think that it is possible for us to save it. And that's something that I wanted to be a part of. And I think building technology for the industry is one of the most necessary ways to do that.
I love that. And what do you think, like, tell me a couple of technology pieces that you have that's really at the forefront right now when you look at Valerie compared to a lot of other networks out there?
Yeah, so I think the big one is on the valuation side. Like, so we do home evaluations that use AI rather than what's called an AVM, which is an AVM is like a boosted regression. Most of your like appraisal companies would use these for like a desktop appraisal, but they're not super accurate, right? Like you can use an AVM to say whether or not the person is within, 50K or 100K of what the property is worth to protect a bank. It's like, that's a good use case of an AVM. But for something as delicate as the value at which you're going to list a property, it's important because if you list a little bit too high or a little bit too low or whatever, you're going to get, you're creating risk for your client. So a realtor could come to me if I've listed a property and they say, well, here's 5 comps around the corner. Well, this is what we're pricing it based off of. And an AVM wouldn't capture that. An AVM would capture the entire universe of comps and create a value based on that. Ours actually looks at all of the photos. I'm not even really afraid to like show people what's behind the curtain because I know it's so incredibly hard to build this that like I'm not worried that somebody will steal it. But looks at all of the photos. It goes and searches for comparable listings. It starts with geography and time, so the closest number of bedrooms, bathrooms, etc. And then it will actually go through photo by photo and pick out ones that have comparable kitchens, flooring, blah, blah, blah. And it will find the best comps for properties the same way that a realtor would. It does the same process that a realtor does. That would probably be the best example of, and the reason I think it's the best example is the entire process of real estate just comes down to getting the right price for both sellers and for buyers, right? As a seller, most realtors all have comparable marketing. You got staging, where they're going to post it on the internet and whatever. It's possible for agents to all offer the same or comparable marketing, I think. It's really hard for an agent to be super competitive on winning on marketing. So as a seller, your primary marketing tool, the one thing that you can do to improve the marketability of your property is price it correctly. So pricing matters a lot. Same thing, if you're a buyer, if you want to de-risk your ability to, when you're buying a house, you don't want to close with negative equity, you don't want to have a ton of risk built in, you don't want to be house poor, all of these things, then you also need to pay the right price. So to me, like that's probably solving the most important piece of the puzzle. The other thing that we've done, I think, really well is like we have focused a lot on leasing. And I think one of the reasons with this is I've always had the opinion that Canada's policy direction was heading us towards a renter's economy. And I think you're starting to see that now on the real estate boards. More rental listings were listed on MLS in the last month than ever before. And that's been a trend that's been hitting new all-time highs for the past several months. More transactions have been done on the Toronto Real Estate Board so far this year that were rentals than sales for the first time ever. So realtors are very much becoming rental agents. And I was going to say at risk of becoming rental agents, but we are becoming rental agents. So there's nothing necessarily wrong with that, actually. To be honest with you, it's an honorable trade and craft, and you're still helping people find housing, and it gives you a greater consistency of income, right? Our industry is famous for like these huge ebbs and flows in the income that you're making. You make a huge commission, maybe a couple of houses you sold in the spring market, and then you don't see any money for 6 months, and then you do the same thing in the fall. And I think that leasing really actually steadies that for a lot of people. And so I think a lot of realtors in the profession, we're starting to see more people get into leasing. And for us as a technology company, we really like that because it allows us to refine our technology faster. The more that we can iterate, we're in a much faster sales cycle. So we're doing leases. They take 1 to 2 weeks or months rather than 6 months or a year to do a lead to lease sales cycle rather than a lead to sales cycle. And that allows us to develop our technologies faster.
And I think in some aspect, there will be different regions that will be more heavy in that lease area because, to your point, like Toronto, it's expensive, right? And you don't have that younger generation of people being able to have full-time jobs. It's more part-time jobs. So they might need to lease for a lot longer. And again, that first-time home buyer, that age group has increased. You had the graph on the market update. It's like 40 years old now, right, for a first-time home buyer.
Yeah, I think it's almost 38 years old. And it's interesting because like on the side of like leasing, like we're seeing more people get into leasing from a business perspective because there's fewer transactions for sale as well. Like those violent swings weren't as bad in 2021 when everybody's doing tons of deals and there's very little work. But since like 2020, we've increased the number of realtors by like 10,000, over 10,000. So we have the biggest real estate board in the world, most realtors per capita in the world. And the deal volume is, it's a little bit below normal, but even at normal, it's going to feel like too competitive, right? Too few deals, you're losing too many deals to Uncle Bob and, Cousin Tony and whatever. And so a lot of people are going into the leasing space out of necessity because there's not enough income to be made in this industry for the average agent.
So is that your recommendation then, if you've got a realtor that's watching this, what to look for, maybe if they are looking to make a move to a different brokerage or to a different direction in terms of, like you said, a consistency of income?
Yeah, I think a lot of it comes down to that financial literacy, right? It's like, can you withstand making $60,000 in Q1 and then no money and then $40,000 in Q4? Like, if you can, then that's fine. But most people, to be honest with you, can't. They're going to go and spend it all, or they're pre-spending it and paying off a line of credit or whatever. And so steadying that income, I think, is something that is going to be very helpful for most realtors to model their business better. It's almost like you get this like MRR, right? Like a more monthly revenue. And then you can, most agents don't look at their costs from a variable perspective. So like if I made $1,000, I should be taking a percentage of that, whatever I've budgeted for, and putting it to a portion to savings, a portion to investments, a portion to marketing my business, right? Growing my business, and cutting that up and knowing how you're going to allocate every dollar before it comes in, so that you don't put it into dumb stuff. And if it ends up being a $60,000, double end deal that you just closed, then great, take 10% of that. That's the same thing. It just means more money to marketing, more money to savings, more money to your investments, whatever. But I think the steadiness, especially for agents, so many agents are struggling right now, especially the ones who are new. It's a really easy way for them to get more out of the industry right now. And so we've really focused on building a really solid system for agents to go from lead to lease and succeed in that space and make it easy, because we know like the biggest complaint for people is it's so much work for so little pay. But we have a couple of agents that are making more money than sales agents just doing leasing. They're doing like 10, 20 leases a month. And, Dave Hutch, who, is our all-star broker at he in his first year of the business, first or second year of the business, I think he did like over $300,000 in leases, right? Like, it's possible. But a lot of people just don't want to do it, and they're still focused on the sales piece. But the sales piece is just so much work to get a deal, and so little reward, and so high risk. Like, you go get a listing right now, you don't even know if it's going to sell. Yeah. You get a buyer right now, you don't know if they're still going to buy, if they're too scared because their friend lost their job or whatever, right? So I just think that to me is the future of the real estate industry, and I think the sooner that real estate professionals accept that, the better they're going to be in the long term.
Yeah, and take advantage of systems like you have, right? Which is incredible.
Ideally,
and the team.
That'd be nice, yeah.
Yeah, no, and it's the team. And I think that's part of the reason why we partnered with you and everybody out of Valerie's, because of the systems and processes and, like you said, the AI technology. And people want quickness out there in terms of making decisions. They want to be able to get that information or look at opportunity. Like, okay, here is a report that gives me opportunity or leverage in a market that I need to, potentially lease or buy in. So let's look into next year, your crystal ball. What areas do you think would be ones that are going to thrive in Canada for homeownership? Or what do you think, where do you see people migrating to?
Yeah. I think, the markets that seem to be doing well are places where people can afford to buy houses. So like an easy comparison would be like Toronto to Ottawa. So Toronto is really suffering. Prices are still grinding down. Ottawa's basically stabilized. Why? Because as a percentage of household income, house prices and getting a mortgage are a lot more affordable. People make a lot more money in Ottawa because most people are employed by the government, but house prices are also significantly lower. You want to go further with the comparison, you could look at a market like Calgary, where they've kind of grown like crazy, and it's seemed to plateau, and it seems to be rolling over a little bit, but it's not going to see a violent crash like we saw in Toronto. So I think a lot markets where people can afford houses will do fine. Markets where people can't afford houses, mostly Ontario and BC, are not going to do fine. So those are the big things. I do think that within those, there are probably opportunities for the biggest thing that I see as an opportunity in the market right now is whatever municipality in Ontario reduces their development charges by the most and makes it most competitive for builders to be able to release product will do exceptionally well. They'll see a lot of job growth. They'll see a lot of growth of tax base. They'll see a lot of houses get built. They'll see a lot of young people move to those markets because builders are now building houses for first-time buyers because of the HST rebates. And they potentially will see a lot of rental housing created in that market as well. You're starting to see a little bit of a race to the bottom on development charges in the first ring of suburbs around Toronto, as an example. So Mississauga dropped by 50%. Vaughan dropped development charges. If all of those municipalities continue competing on that, and then eventually Toronto's hand is forced because they're watching all of this development business leave the city and go to the 905, then that would, to me, create a lot of opportunity in that market for first-time buyers and for rental construction in the GTA. I think that's a long part of the cycle. And one thing that people miss when I mention this is that everything I just described is deflationary, right? So house prices will go down if development charges go down. New house prices just got cheaper to build by 20%. And so you would assume if I'm a builder, I'm going to capitalize that into the cost structure of my units. There's a very easy example of this. Mississauga dropped development charges by 50%. Green Park launched a site at $875 a foot, parking in Lakeview Village, and sold somewhere between 60 and 100 units. Wow. I don't want to reduce my prices as a builder. It sucks, right? It's going to piss off all my other buyers from the last little bit, but I also have a business to run and I have a product to sell. And the only way to do that is to meet the market where it is. I can keep my prices at $1,200 a foot and sell nothing, or I can drop them to $875 and sell a lot of units. And so I think that's a big trend that's going to happen as well.
So on that note, let's talk about builders that built like 3 years ago, or let's just say pre-sold, right? Condominiums, which was one of the biggest things, I think, back then. And they're coming up to completion now and getting registered. I think we're going to see probably the most of those in the GTA area get completed. I know we're seeing them in our local area here in KW, where construction is completed. It's registered and now occupancy, where these owners of these units are going to have to work on financing. And, you know, we're seeing it where these values are like, you know, $250,000 less than what they paid for these units, you know, 2.5, 3 years ago.
For sure.
What do you think the fallout from that's going to be, or what's the correction? Do you think the government will actually get involved in this at some point?
I think the government's pretty involved already unintentionally. So I think that like one of the ways that they're involved is that they've turned a blind eye to blanket appraisals, which is, you know, functionally a violation of the Bank Act. They're allowing lenders to lend at 100+% of value based on appraisals at loan to cost, right? Or loan to purchase price, let's call it. And I get why they're doing it. So I'm not like saying this to tell them to stop or disrespect them or anything, but that's happening. And I think that, you know, OSFI allowing it to take place is the government being involved. I think that the fact that 88% of apartment construction right now is financed or insured by CMHC is the government being involved. Basically, you know, they've made it possible for any builder who hasn't massively overpaid for their land and can reduce construction costs somewhat, can convert a project to rental, you know, where the economics work. And I think the economics are improving. So creating the avenue for builders to pivot some of those projects to purpose-built rental is them helping. Doesn't help a lot of the ones that are, like you just described, sitting on units that could potentially fail to close. Do I think that they'll get involved with those units, the inventory units? I don't. I think that they've already done the most, as much as they can without causing an uproar. I mean, I don't think that I bailing out builders is not going to go over well. Right?
I know. Yeah.
You know, I thought that maybe they would expand the CMHC MLI Select product to inventory units, but you can now get, I think, CMHC Standard on inventory units. And I think that, I mean, inventory units are scary. Like, that's a huge issue, right? So you get, you get the situation that you've described. Let's assume they can get a blanket appraisal and close the project relatively successfully. Right now, statistically, about 22% failure rate for closings. So people showing up on closing and saying, I'm just not going to do it, sue me, whatever. So that happens. And then you've got builders who probably held back 30% of inventory because they were, you know, bullish and wanted to sell units at a higher price on closing. So, you know, some builders are sitting on maybe up to half of a building, up to 50% of a building is just sitting there empty. And from the moment it's built, or occupancy permit, I guess, closed as a condominium, to I think it's 2 years, then they actually have to start paying in Toronto the vacant home tax. And so there's a whole bunch of like issues, potential catalysts that could really make this a bit of a mess. And so I think that like one of the things that we're really pursuing with our leasing program at Valerie is approaching builders on inventory management. We have a property manager that we've partnered with that does inventory management, and we want to be leasing those out because it's really the best. It's the best and only option for developers of that type is close on the unit, get CMHC standard. I think you can get on those groups of units. And so it's still sort of the government supporting them, right? You can get a 30-year AM, I think. The rate's pretty reasonable. And rent them out, and basically you're losing cash flow every month, but you're technically servicing principal and interest with the rent, hopefully, based on current rents.
Yeah.
So you would be hemorrhaging cash for a while, which is probably, I mean, you don't really have another option, right? You're either losing a ton of money and writing down all the units and hemorrhaging way more cash, or taking that loss and spreading it out over several years. And I think you just lease them out and you try and sell them off over the next 5-10 years when you feel like you have an opportunity. If you get a buyer for a unit, you sell the odd unit off. And I think that's what the format that all this inventory is going to take. Like builders are just going to take possession of the units. They're going to put it in term debt on it rather than an inventory loan, and they're going to rent them out. And
to your point, I think that's why leasing is such a good opportunity at this point, right?
Well, I mean, rental rates aren't going to go up. So like leasing is going to become like home housing affordability. If you look at like the monthly cost of owning a house versus the monthly cost of renting a house, there's a huge gap right now in most major markets, Toronto, Vancouver, et cetera. The cost of leasing is continuing to trend down. The cost of ownership isn't trending down as quickly. It's basically like flatlined. The spread tightened a little bit as rates and prices came down. But as long as that spread is there, you would assume like, okay, you go to New York City, right? All these like Wall Street bankers all rent their properties. Why? Because they're financially sophisticated and they know they can get a better rate of return. Toronto, more finance-minded people, you're probably going to get more people who just say, I'm just going to rent. I'm going to go put all my money in NVIDIA stock, or not financial advice, but like whatever, and get a better return. That to me is probably the direction that we're headed. You go look at like any major market, go to like Frankfurt, it's like 20% homeownership rate, right? New York, like 30% homeownership rate. That's where Toronto's going. We're 50-50 right now. That's why Mamdani won in New York. That's why Olivia Chow won in the city of Toronto. That's why it's going to continue happening, because they're all becoming renter-centric markets. So, it's the opportunity for real estate professionals. Like, go look at New York. Like, everyone's a leasing agent. Realtors are leasing agents in New York.
So you just said it there. It's like there's always opportunity. It's just a matter of the lens you see it in, right?
For sure.
And making sure that you take advantage of that.
Thank you very much for listening to the Beyond the Mortgage podcast. I am not your host. I'm the guest, actually. But thank you for having me, Tracy.
Well, thank you, Daniel.